Well, hello and welcome to Principles of Accounting 1. I'm your host, Dr. B. In today's session, we'll be discussing internal controls and cash. We will also be discussing concepts of adjustments. Before we get started, I would like to go over a couple of key housekeeping announcements. Go ahead, Pavle. You good? Okay.
I didn't say anything.
Okay, sorry. Thought that was you. We're going to go over a couple of key housekeeping announcements. We are currently in the fourth week of our course. We're halfway through. So what does it mean when we're halfway through a course? We have midterm exam, right? Very typical of being halfway through a course. You're like, oh, Dr. B, it's only 4 weeks. This is an 8-week course. So we are halfway through an 8-week course, and we are now in the fourth week. So let's talk about what we've done so far, what needs to be done, and what the next steps are. First week, we went over Introduction to Accounting. We discussed a couple of other key accounting points. In your first week, you had a quiz and a Chapter 2 homework. In week 2, you had a Chapter 3 quiz and a Chapter 4 discussion. Now we're even beyond that, right? At Module 2, Week 3, last week, you should have completed on time, which was due this past Sunday. All the work in this course is always due on Sundays. It's very clear what the due dates are, yeah? So last week, you should have completed the Chapter 5 quiz and the Chapter 6 homework. Now here we are in week 4. We're halfway through the semester. Yeah, well, at least for this course, we're halfway through it. Yeah, this was an 8-week course. We're in week 4. That's halfway. So what's happening this week? Now, this week we have a Chapter 7 discussion board and a Chapter 8 quiz and a midterm exam. Yeah, 3 things, right? So by now, by this past Sunday, you should have completed weeks 1 through 3. There are no excuses to be late in this course. There's 2 assignments due each week. You knew it's an intensive course. This course is an intensive course. There are 2 things due every single week. It's imperative that you're on time every single week. Why? Well, here we are in week 4. We're halfway through this course. If you didn't do some of the work, you're failing the course. You know that every single assignment, whether it's a quiz, a discussion board, or a homework assignment in Cengage, it's worth 5% of your total grade. Okay? So if you miss 2 assignments, whether it's 2 discussion boards or a discussion board and a quiz or a discussion board and a homework assignment, you dropped a full letter grade total for the course. Yeah. So don't let that happen. So here's the deal. This week, you have 3 things to do by Sunday night. And I'm telling you by Sunday night. If it's not done by Sunday night, you will fail this course. And I will not allow you to make it up. So sorry. That's how college works. You have to be on time. So where are we? This week you have the Chapter 7 discussion board, the Chapter 8 quiz, and the midterm exam. The midterm exam is currently open and available. You can start it today, save it, come back to it. It's open book, open note. Here's the deal. The midterm exam, how much of your total grade is it worth? Does anyone know? Who can tell me how much it's worth?
Is it like 10 or 20?
Yeah, it's like 10 or 20%. Yeah. So in that case, it's imperative that you do well on it. It's 10 or 20 questions. I forget how many questions it is. True, false, multiple choice matching, just like your quizzes have been. So if you've been taking the quizzes and doing the homework from the beginning of the semester all the way through this week, well, guess what? You're probably in really good shape for that midterm. You're going to see a lot of similar questions on the midterm exam that's due this Sunday night. So if you've been doing the quizzes, you've been doing the homework, you've been participating in the discussion boards, you're going to be in really good shape for the midterm exam that's due this Sunday night. Go ahead, Dante.
Sorry to cut you off. Is the midterm on Cengage or is it on Blackboard?
Nope, it's on Blackboard. Everything's on Blackboard, Dante, even the homework. Because remember, you got to access the homework through Blackboard, right? So make sure you're in Blackboard almost every day or every other day or whatever, as much as you can be. Everything is through the content area in Blackboard. That's it. It's very simple. All you got to do is click on that respective week and click on each item in that week to be able to accomplish what you need to do. As long as you do that, you're going to be right on track. The key here is timeliness. You know, that's the biggest concern with this course because there's so much work to be done. You can't fall behind. You just can't. You will fail this course if you fall behind. It's really that simple. If you miss, all you have to do is miss 2 things and not do so well on 2 other things, and you're failing. Because remember, you need a C or higher in this course to pass it. Yeah. And you know that because you've read the syllabus. When you registered for the course, it probably said that somewhere. We talked about that on the first day. So yeah, it's super important that you need to be on time. You have to be on time. And so here's the deal. If you do not take this midterm exam on time by this Sunday night, you will automatically fail this course. Do not miss it. Why is that? Because I have to report midterm grades to the university by Monday. Okay? If I report that you got a 0 on the midterm exam, it's not going to be good. So please, please, please make sure you take the midterm exam on time. It is due by Sunday night. You can start it now. You can open it. You can save your questions. You can come back to it. Okay? There's only one shot. It's not like a quiz. There's no multiple options. There's only one shot at the midterm exam. So please make sure you do that. And you do it on time. And you do it well. Any questions? I'm sorry I got on my soapbox, but it's so important. I don't want any of you to fail. I just want you to know that. I feel terrible when I have to fail a student. I don't want to fail any of you. I did say this at the very beginning of the semester, the only time you'll fail is when you fail yourself. Okay? That's by not doing the work. So make sure you do the work. Please, I see Richard, your hand's up. What's going on, Richard?
Yeah, good morning, Professor.
Good
So
morning.
my question is, what is the midterm covering? What material?
Yep, thank you for asking the question. I appreciate that. It covers chapters 1 through 8. 1 through 8.
Great, thanks.
Yep, my pleasure. So what I recommend that you all do in order to do well in the midterm exam is, number 1, make sure you fully understand the homework and the quizzes from the previous chapters 1 through 8, okay? Now remember, if you didn't do so well on a quiz, you could take a quiz up to 2 times. So make sure you take it that second time if you need to, okay? For homework, again, only access things through Blackboard. Do not go directly to Cengage. It's not going to work. You have to access it through Blackboard. Make sure you log out of Cengage and access it directly through Blackboard for it to work. If you did not do so well on a homework assignment, you have unlimited tries. Unlimited. So what does that mean? You can go back and answer those 5 questions again and again and again and again until you get them right. As I said before in this course, practice makes perfect, right? That's what accounting is. It's a practice. It's a practice. It's like a lawyer. Lawyer is a practice. An accountant is a practice. A doctor is a practice. These are all practice. They call them practices, right? The reason why they call them practices is because they're constantly practicing. And so accounting works the same exact way. So again, as a reminder, if you're not satisfied with your quiz grade, you can take it up to 2 times. If you're not satisfied with your homework grade, you can take that unlimited times. And for some of you, I recommend you retake it, the homeworks. Okay, if you didn't get a 5 out of 5, retake the homework. Okay, it only takes you, maybe an hour or so. And if you didn't get a 5 out of 5 on the homework assignments, that means you didn't understand the content all the way. So what do? Try it again. The other great thing with that, and Pavle pointed this out earlier, is on the homework assignments, there's a button that says Show Me How. Show Me How. When you select that Show Me How button, it brings up some videos. It brings up some exercises. It basically shows you the concept, right? And so it's very helpful to take that route. And then, of course, if you have other questions, you just ask me. I'm here for you. Regina says she always uses that button. Yes, definitely always use that button. It's a great button, Regina. Yes, absolutely. Totally agree with you. So any questions? I'm sorry I got on my soapbox. I just want to make sure that we're all on the same page. It's really, really important.
So one more question.
Yeah, please.
Okay, so the assignments, the homeworks on Cengage that were due have already been graded, obviously. So if we, let's say, got a 5 on it, but we want to go back and practice, does it change anything?
No, it won't change anything because it'll always take the highest grade that you earned. Okay. That's the same with quizzes too. So like if you took a quiz and you got a 4 on it, and then the second time you took it, you got a 3 on it, it'll still take the 4. It'll still take the highest grade. Yeah, good question. Absolutely. Any other questions before we jump into this week's content, and then we'll discuss the exam?
I have a question, Professor.
Regina, yeah.
So when you said make sure you take it over until you get a 5 out of 5 for the homework, so I got frustrated and I seen the show me button, which I always use, and I was working out. So like for part 3 of the question, it was 3 parts in it. Okay. So one of the parts I didn't get for that, and then on question 5 or 4, I did the same exact thing. So it gave me an 86 point something. So I was getting irritated because I kept doing it over, and I think I emailed you about it. You did. But I just finally submitted it, so it gave me a 4 point something out of a 5.
Well, it's still pretty good, but Regina, I'm sorry, I probably didn't see your email, or maybe it got lost, or somehow I didn't get it. So if you wouldn't mind just resending that to me, I'll be happy to respond to your question.
Okay.
But thank you so much.
You're welcome.
And I'm happy that you use that feature. It's a great feature to use. Yeah. Any other questions before we jump into it? We're all good. Okay. And as always, if you think of something, just let me know. Okay, I'm here. Let's jump into chapters 7. I'm sorry. We're going to do 7 first and then 8. Chapter 7. This is an easy chapter, so we're going to breeze through a lot of this. It's mostly qualitative stuff. Okay, internal controls and cash. Internal controls. When we talk about internal controls, we're talking about how the business manages itself, how it controls its assets, how the business protects its assets. That's what internal controls are. How does the business control the flow of cash? Yeah. How does the business protect its assets from theft? How does the business protect its assets as they're being used? Question? Or okay? Okay. Let's jump into a couple of laws that were generated to protect investors and to protect businesses. We'll also talk about methods of controlling cash, which is the primary topic of this chapter. And then we'll discuss a couple of key items. First one here is the Sarbanes-Oxley Act. Sarbanes-Oxley Act 2002, it was developed in order to build public trust and confidence that publicly traded companies are honest and transparent in their financial statement reports. As an investor, you have the right and responsibility to review a company's reports, their financial statements. Yeah, you can access any company's financial statement that is publicly traded by visiting sec.gov. That is the website for the Securities Exchange Commission. Again, that website is sec.gov. And if you visit that website, you'll be able to search for a company that you're interested in investing in. Maybe you're interested in purchasing a stock or getting into bonds, or you're just interested in the financial performance of the company. You can visit that website and you can search for that company, and you'll find that each company is required that is publicly traded, is required to post their financial statements and their reports. There's one particular report. It's called the 10K. It's 10-K is the name of the report. That is an annual report that companies are required to publish. And in that annual report, the company will discuss it. In addition to the financial statements, they'll publish, of course, the income statement, balance sheet, statement of cash flows, the statement of retained earnings. And they'll also have a manager's discussion area where the company discusses its guidance. And you'll also see a statement for internal controls. Internal controls stems from the Sarbanes-Oxley Act, and it requires companies to disclose how they safeguard their assets, how they process information, and how they work with regulators to ensure they are complying with laws and regulations. So overall, the Sarbanes-Oxley Act has been very effective in helping investors and others who are interested in publicly traded companies to ensure that what they're reading is true and accurate and transparent. It's a nice visual representation of what the Sarbanes-Oxley Act. How did it come about, you might ask? Well, it started because a couple of companies that were publicly traded were intentionally defrauding investors by stating that they had higher sales than they actually did, which is, by the way, illegal. And so they did that in order to attract new investors. A couple examples of this happening are Enron, Health South, Bell Company, AT&T did it way back when. There's a couple of other well-known companies that have committed this fraud. And so in order to prevent that from happening in the future, that's what the Sarbanes-Oxley Act was created for. It started because there were weak internal controls in companies, fraud and theft, and investors, stockholders, and creditors were defrauded. Sarbanes-Oxley Act was introduced in order to prevent that from happening. So after the Sarbanes-Oxley Act was passed, it forced companies to be more effective in their internal controls. They had to identify ways that they prevented fraud and theft internally, and also was designed to protect investors, stockholders, and creditors. It also required that companies that are publicly traded are independently audited. Their financial statements are independently audited by a third party. The third party being one of the public accounting firms. We call them the Big Four: KPMG, BDO, PricewaterhouseCoopers, and there's another bigger one that's out there. I forget the name of it, but those are typically what we call the Big Four. Those are the ones that audit a company's financial statements to ensure that they're transparent and accurate.
One question.
Yes, go ahead, Pavle.
is that like a private company or it's a government company?
No, so they're publicly traded companies, which is the difference between government and private. So publicly traded companies are companies like GameStop, companies like, well, I would say Sears, but companies like J.C. Penney, Macy's, Microsoft, Apple, Tesla, all of the large AMC, yeah, good example of Richard. A lot of the large companies that have been around for a while, and the reason why they're publicly traded is to attract investors to buy their stock. So any company that has stock is typically publicly traded on the stock exchange, and if it's on a stock exchange, it's governed by the Securities Exchange Commission, which means it's also governed by the Sarbanes-Oxley Act. Does that help to answer your question, Pavle?
Yes, thank you. Thank you.
Okay,
Yes.
thank you. Good question. Wonderful. So why do companies have internal controls? A primary reason is to protect their assets. Assets include cash, you know the assets, they're on the balance sheet. Cash, property, plant, and equipment, accounts receivable. There might be a few other obscure ones, but those are your primary assets, right? The idea is to protect those things. And you could include employees, I guess, as an asset for the most part. Business information, the idea behind internal controls is, of course, protect your assets, to help to ensure that the financial statements are accurate, and also to ensure that employees and managers are complying with local laws and regulations. Internal controls are really important to every company because, even if it's a private company, the reason why a company needs to have good internal controls is to ensure that the company is well protected and that they are following laws and regulations. And of course, to make sure that their financial statements are accurate. Without internal controls, a company is very susceptible to having some serious problems. And so that's why internal controls are very important. So along those lines, companies need to prevent fraud. Fraud is the act of intentionally or unintentionally deceiving others. That's fraud. Okay. It doesn't necessarily mean theft. It can mean theft. Fraud and theft are actually different to some degree. Fraud is the unintentional or intentional act of deceiving others for personal gain. That's fraud. Employee fraud is the act is the intentional act of deceiving their employer for personal gain. Employer fraud, which also happens, is the opposite. It's the employer is intentionally defrauding the employees for personal gain. That happens too. And of course, there's other types of fraud, but these are the ones we talk about when we talk about the Sarbanes-Oxley Act and internal controls. So how do we prevent fraud? How do we prevent risk? We utilize what we call the elements of internal control. We control the environment, risk assessment. We provide a risk assessment. We establish control procedures. We continually monitor company performance, and we provide accurate and clear information and communication to those involved. Controlling the environment involves controlling the physical environment. Okay, an example. I hide my wires to prevent people from tripping. Okay. I salt my sidewalk to prevent people from slipping. I establish security cameras, metal detectors, and locked doors to prevent theft in the environment. So forth and so on. That's the idea of controlling the environment. Risk assessment is where I look at all of my factors, the environment, the market, the political factors, social factors. I look at all of these things and I assess any type of risk for my business. Some of you who have probably already taken Introduction to Business, you may have learned about this concept called the SWOT analysis. That's where the business looks at their strengths, weaknesses, opportunities, and threats. That's basically in finance and accounting, that's what a risk assessment is. It's like a SWOT analysis for finance and accounting. Yeah, that's pretty much how I could best describe it. And we'll talk more about it. Control procedures. This is a set of rules and standards that a business establishes in order to control their processes. Monitoring is both the physical and the environmental monitoring. Physical monitoring includes use of security cameras, supervisors, one-way mirrors, all that fun stuff. Then you have the environmental monitoring. That's like comparing your financial statements from 1 month to 1 month to monitor the changes. So oftentimes when we see what we call an anomaly is a unexpected change. When we see an anomaly in our financial reports, that we've discovered that through monitoring, and then we can mitigate that risk or identify what that change was through monitoring. We'll talk more about that. And information and communication is important to speak clearly, honestly, and transparently to employees, stockholders, creditors, the government, so forth and so on. The idea behind internal controls is to control threats from the outside. That's what this nice illustration shows. So again, controlling the environment is both perception and physical. So perception means the overall attitude of management and employees and the importance of controls. And then, as I said earlier, the physical environment would be the use of like security cameras and locking doors and metal detectors and all that other good stuff to protect your assets. Factors include around controlling the environment is management's philosophy and their operating style. Also includes the company's organizational structure. Philosophy and operating style, and you probably learned about this also in your Intro to Business course. Philosophy is how the managers interact with their employees and how they approach management. The organizational structure, as you know, is the framework of the business. Typically, a typical business will have like a CEO or a board of directors at the top, and then you'll have your top line management. That's your CFO, your COO, your CIO, all of the chief officers of the company. And then below them, you'll have your directors and your managers. And then below that level, you'll have your employees, your day-to-day employees, right? That's the typical framework of an organizational structure. Every business has their own take on it, but that's just a kind of a standard structure. Businesses can have their own organizational structure. They don't have to follow a single structure, but that just gives you an idea of what a organizational structure looks like. And of course, in the control environment, the company has what we call personnel policies. These are policies around hiring, training, evaluation, compensation, promotion, and firing of employees. Typically, you would find these policies in what we call a employee handbook. You'll also find job descriptions, employee codes of ethics, conflict of interest policies, and anything else that is involved in personnel. Personnel, as you know, is another term for employees. It's a fancy word. The cycle. So here's this. This is kind of an idea. The cycle of controlling the environment typically stems from the CEO. CEO dictates the organizational structure. The employees inform policy. Policy informs management's philosophy and operating style. And then the cycle goes round and round. It's just it's a concept. It doesn't have to be this way, but in most cases it is. Risk assessment. Risk assessment, we look at factors such as changing customer requirements. Like, for example, you used to like Apple, now you like Android. That's a changing customer taste or style, right? Customer requirements. Some customers need to have certain features in their phone or whatever. Competitive threats. Android is a competitive threat to Apple. Regulatory changes. The government recently stated that there is a chance that the corporate tax rate will increase from 21% to 28%. That's a potential regulatory change and will have a negative impact on the economy. Changes in economic factors. We are currently experiencing a temporary recession as a result of COVID-19. That is an economic factor. We will rebound from this, and we will have what we call an economic boom. More jobs, more opportunities, as soon as the vast majority of our population is vaccinated. Management should identify these types of risks, analyze their significance, and the likelihood of them occurring. I don't think anyone saw our current situation coming, but now that we're in it, management had to pivot, right? We had to identify this as being a primary risk to our business, and we had to take the necessary actions to minimize this risk. Control procedures help management to identify reasonable assurance that the business goals will be achieved. This includes preventing fraud, right? Control procedures include identifying our personnel and making sure that they're competent. We continually rotate their duties, and we make sure that we have mandatory vacations. I wish that were true. Mostly true, right? Employees, they're competent. It kind of makes, it's like saying, oh, you know how to do your job and you do your job well. That's competency. Rotating duties. In accounting, we don't always want the same person collecting the cash from our customers. So in order to prevent theft with cash from customers, we'll rotate our employees. Okay, so instead of collecting the cash from customers, today you'll be taking inventory or another duty, right? And sometimes we rotate our employees in order to control that competency. Separating responsibilities for related operations. Years ago, when I was a financial controller, I would have an employee that was only responsible for accounts payable. I would have another employee that was only responsible for accounts receivable, and I would have a third employee that was only responsible for payroll. By separating their responsibilities, it helped to promote a set of controls. Another thing, which we'll talk about the next item here, is separating operations, custody of assets, and accounting. With this, we, as a financial controller, we also had two people that had to sign checks. Two people. One was the company's treasurer. The second person was the company's financial controller. The reason why we had two people sign our checks is to ensure that the assets are properly being allocated, right? It's a way of preventing theft, a way of controlling the asset. And we also made sure that we had security measures in place. So I talked about this, but making sure that companies are successful in their operations, we typically try to rotate them out and we give them tests and things like that. Procedures are established for training and supervising. It's important that we continually make sure our employees are learning. For those of you who are currently working on the front line or in a position where you're in retail or anything like that, if you're interested in being promoted in your role, I strongly recommend that you try to approach your supervisor and ask for additional training on other roles. The idea behind that is the more skill sets that you learn for your related jobs, the more benefit you gain from it. You might not get more pay right away, and that's okay. The reason being is because the more things that you learn about your job, about other jobs, the more promotable you are, and the more that management will look at you for those types of promotions. So just a tip, I guess, because I was in your place once, and that's what I did, and it worked out pretty well. So in accounting, we don't want the same person always counting physical cash. So an example, many years ago when I was working at Sears, I was responsible for a department, and my department, we collected a lot of cash. And as a manager, I was responsible for counting the cash, making sure it goes into the deposit boxes and all that, and make sure it gets to the bank. We would never have one person doing that. Okay, it's really important that you rotate those people to prevent theft, right? And so the idea behind it is you have more than one person counting cash at the same time. It's not always possible in smaller businesses, but it's ideal to make sure you have more than one person doing it. Yeah. That takes us into separating responsibilities. You also don't want the same person. Oh, this is a good one. You don't want to have the same person receiving the inventory and putting the inventory on the shelf. Here's why. I should have said, you don't want the same person placing an order for inventory. That same person should not be the same person receiving it, and should not be the same person putting it on the shelf. Here's why. I can simply place an order with my vendor and say, hey, that bottle of liquor that I ordered, don't put it on the packing slip, right? And then it goes into your trunk instead. You know what I mean? So, and that type of stuff happens a lot. So that's why it's important to not have the same person placing the order for inventory and receiving it. Yeah. Orders may be placed on the basis of friendship with suppliers, and that causes problems. Yeah. Exactly, Regina, and that's what happens. So Regina said in the chat, she said, so they can collect goods for themselves. Yeah, that's exactly what happens sometimes, is the employee places the order, and if that person's also the one receiving it, and instead of it going onto the store shelf, it could go right into their trunk out in the parking lot, especially if they become friends with the vendor. Yeah, it happens a lot. And that's what this slide talks about. That's why it's important to have those things separated. Custody of assets. This one's good. So we call it the chain of custody. Chain of custody. So when we receive cash from a customer, it goes into the cash register. From the cash register, we count out the drawer, right? To see how much cash is in the drawer. Then we count back what needs to stay in the drawer, and the rest goes into a deposit bag. That deposit bag should then be initialed, it should be sealed, and then delivered to the management. Management then recounts it, opens it up, recounts it, reseals it, and puts it into the safe. Then it goes from the safe to the bank, right? That's the chain of custody, and that should always be done for cash handling. Very important concept. Security measures are designed to protect assets and also to protect employees and customers. We've seen a lot of crazy things, especially in retail. One of my favorite, well, not favorite, it's not that funny, but it's kind of funny. Customer goes to the grocery store. The customer trips and falls on slippery floor, okay? Yeah, there's signs everywhere that says the floor's wet. Why do you think that is? Because the customer is going to slip and fall and then sue the company, right? That's what happens. Unfortunately, that happens a lot. And so that's why you go to the grocery store, somebody just mopped the floor, you see a sign, the floor's wet. Yeah, for good reason. So the reason why that sign is there is to warn you, the floor's wet, don't slip and fall. If you slip and fall, it's not in the store, you knew the floor was wet, right? That's why those signs exist. So yeah, we've seen that. And then, it's funny because when it's on camera, that's the funniest part, because you can almost tell the ones that are faking that fall, right? It's like they fall a little awkwardly, yeah, it's just interesting stuff. So that's why cameras are super, super important, especially in retail businesses. So yeah, all of these things are control procedures, and we help to prevent external threats to the business by using these control procedures. About monitoring. Monitoring is an internal control system for identifying weaknesses in the control process. Monitoring, as I said earlier, we monitor financial statements for anomalies. It's really important that we do that, because if there's an anomaly, remember, anomaly is like a weird difference that happened for no apparent reason. So when that happens, we investigate that anomaly to understand what the change was. Typically what happens is it stems from a change in behavior, right? I do the same thing for students, right? Like if I notice a change in your pattern or changing your behavior, I'll oftentimes approach you and talk to you about it. Say, hey, I noticed that you missed last week. Is everything okay? How can I help you? Got to get you caught back up, right? So a change in behavior often leads to other potential issues, right? And so the idea is to help you to identify that change in behavior and to be able to get you back on the right track. I do that through monitoring. I do that through monitoring your patterns. Because the beautiful thing with Blackboard is it tells me when you logged on, how long you were logged in for, what you did while you were in Blackboard, all of that great stuff. A ton of awesome detail comes out of there. It's very powerful stuff, right? Very powerful software. And it helps me as a professor to identify your trends and your patterns and your behaviors. And so when I realize something is amiss from your normal behavior or pattern, that's when you get that fun email from me or that phone call and saying, hey, everything okay? What's going on? I noticed that this is late, or I noticed that, this happened, or whatever. So, and that's how I know. You're probably like, oh, how does Dr. B know I missed that? That's how. This is very powerful stuff. Good information. I do that through monitoring. And companies do identify through monitoring. We can identify warning signs in both people and in systems. A warning sign in people are changes in lifestyle, refusing to take vacation. Yeah. I don't know how many people that refuse vacation, but some do, I guess. Frequent borrowing, other personal issues. Those are warning signs in people. And it's important that employers can be able to identify these warning signs to be able to help the employee and to get them back on the right track. Warning signs in accounting systems: gaps in transactions, missing numbers, missing documentation, unusual increases in refunds. I've seen that happen too. Oh, my favorite. So one time, I was a financial controller of a hotel company, and one time I noticed there was a lot of voided transactions at the restaurant from a couple of employees. So, of course, that's an anomaly. So I'm like, oh, something's happening. So me being the investigator that I am, I went down to the restaurant and started watching, right? See what was happening. And I would observe employees. They would take the customer's order. The customer would get their food and their beverage or whatever. And when it came time to ring up the sale, especially for cash transactions, the employee would then go to the register, enter it as something else, or enter it as a voided transaction. And what do you think they do with that cash? Right? They pocket it. That happens a lot. It's very common in the service business, the service industry, whether it be hotel or whether it be restaurant, or even sporting venues. Anywhere where there's a heavy flow of cash, that's a common problem. So when you see a lot of voided transactions, you're like, something going on here. Yeah, or you'll see, the other favorite thing that they do is they'll issue coupons to their customers, yeah? Oh, come back and you'll get your next drink is 50% off or whatever. That's a warning sign, because what happens is the employee will give this coupon, charge the customer the full rate, and what do you think they do with the difference? Yeah, it goes in their pocket. There's a lot, they get really creative, yeah, especially in the service business. So I say that just because, I know that some of you are hospitality majors. And so as you enter the field, or if you're not in the field already, these are things to watch out for. Make sure you don't get wrapped up in that game, because it doesn't end well for a lot of people, yeah? So just be careful when you're dealing with cash. Because I assure you, when that cash register knows everything, yeah? So, information communication. This is communication between the business and their customers, the business and their employees, the business and their the government, and so forth and so on. It's to ensure that the business is following legal and regulatory requirements in their reporting. That's all it says. Okay, the fun stuff. Let's talk more about the cash. We talked a little bit about the cash, and I'm sorry. We talked a little bit about the cash. We're going to get more into it. Limitations of internal controls. There's a lot of human factors that limit internal controls, and there's also cost-benefit considerations. Human factors would be like, sometimes employers don't enforce certain rules or regulations. Cost-benefit. It is very expensive for a business to implement certain controls. It's expensive to run security cameras 24 hours a day. It's expensive to have security guards. It's expensive to have metal detectors. It's expensive to have other internal control processes or to have multiple people on staff. So because of cost-benefit considerations, some companies may decide not to implement certain internal controls. It's kind of a shame, right? Cash. What is cash? Cash is paper currency, coins, check, money orders, credit cards. Yes, credit cards are cash. To a business, it's cash. When a customer uses their credit card to purchase something from you, it's the same as cash. Same as cash. We consider it to be cash.
So is it basically because bank pay you right away to the business?
Yes.
Then you pay.
Yep, that's right. Yep, because the bank pays you right away to the business. So what you do at the end of the night is you do what's called a settlement for your credit card transactions. The settlement is basically authorizing the credit card charges that you had throughout the day. And that settlement tells the banks, hey, banks, your credit card holder authorized this sale. Now it's time for you to pay me. And the banks will pay the business at the end of each day for the credit card transactions through the settlement process. And then at the end of the day, or at the end of the month, the company will receive a bill from the credit card processor. And that's just an expense. Good question. Lynette, did you have a question? Lynette? Okay. Okay. Hi, Lynette. Did you have a question? Unfortunately, I can't hear you. It might be the audio connection. Okay, if you do have a question, if you have the ability to type in the chat, or if you want to try to connect another way, that'd be fantastic. I know sometimes the audio's not always the best, especially from a phone connection. I totally hear you. Okay, Lynette, thank you so much. The settlement of phone call. Okay, so I hear what you're saying. So the way that the company settles their credit card transactions for each day is the company swipes the credit cards throughout the day, right? When their customer comes to the store or to the business, they swipe the credit card through the machine. At the end of each day, they go to that machine or that terminal and they click settlement, and then it settles the transactions for that day. So it's not necessarily a phone call. It's more of a computerized computerized thing that they do at the end of each day. And then what happens is at the end of the month, the company will receive a bill for the credit card transactions for the processing fees. It's like 2%, 3%. And then the company expenses that out. Good question. Money on deposit for the bank or other financial institution is available for withdrawal is considered cash. Cash is the most likely asset to be stolen or improperly used because it's cash, right? People can easily pocket cash. How do we control cash? How do we prevent theft of cash? We use receipts. Anytime that we're using cash to make payments or receiving cash from customers, there are receipts. These receipts are a form of tracking the cash. And then we put the cash into a deposit bag that goes to the bank eventually. That is the control process for cash. And we talked a little bit about that earlier. The business normally receives cash from its customers or from customers making payments on their accounts, from their accounts receivables. Remember, cash is not just cash. Cash is physical cash. It's checks. It's money orders. It's credit card use. All of those great things. Those are all cash. If it's instantaneous, basically, it's cash. Another way to think about it. And of course, these days we have a lot of electronic methods for cash. We call those ETFs, electronic funds transfers. Or electronic transfer of funds, ETF, or EFT, whatever. It's all the same. Basically, you can use your phone, right, to make cash payments through Venmo or through some other app, right, some application. Samsung Pay, Apple Pay, Google Pay, all of these fun applications that people use now. Same as cash. It's the same as cash. Absolutely. Because the collection comes out right away. It's important to control and protect cash in all orders in any way possible, especially for over-the-counter through the register. This graphical representation is a little complicated to look at because there's so many different arrows pointing in a lot of different directions. You can see the customer gives the company the cash and receives a receipt and the merchandise. Cash goes into the register, goes from the register and the receipts. Receipts go to the accounting department. The cash goes into the safe. Eventually makes its way to the bank through a deposit ticket. Goes back to the accounting department. Accounting department records all the transactions in the accounting database through journal entries. Yeah, I know. The slide's not the greatest. It's a little confusing, but just shows you a nice visual representation of the flow of cash. Okay, so what happens if you're over or under in your drawer? Oh, man, I've had that happen to me so many times. So what happens when you're over or under? Sometimes the salesperson makes a mistake. I've made plenty of mistakes. I forgot to give a couple customers all their change back. I've had that happen to me. I've done it to other people. It's human error, Sometimes you forget, or you counted wrong, or you grabbed a certain one coin, you thought it was a different coin. It happens. Life happens. We make mistakes. So as a result of these mistakes, we have to account for the difference. To do that, we use an account called cash short or over. Cash short or over. And that's where the difference comes into play. So, for example, customer comes in, buys $1.20 worth of stuff. They give me $2, and I don't give them any change. I'm going to be over 80 cents, right? And so, because $1.20 gave me $2, I didn't give them change, I'm over 80 cents. Or opposite is true. $1.20 sale, customer gives me $1, I process the sale, I'm under 20 cents, right? It happens, that happens. So when that happens, the journal entry we make is a debit or a credit to cash short and over, depending on what it is, and the credit or debit to cash. And I'll show you what that looks like. So here's an example. In this example, we had a cash register. Oh man, must have been a big day. Cash register total cash sales for the day was $35,690. However, cash receipts from the sales were only $35,668. Whoops. Okay, so we're short by $22. We sold $35,690. We only collected $35,668 in cash, which means we're short by $22 in cash. What happened? I don't know. We probably had a bunch of transactions. Obviously, that's a lot of cash. And a few times we didn't get enough from the customer. We said, it's close enough, or whatever. I don't know what happened. But either way, we're short $22. So the journal entry that we make for that day is we debit cash for the amount of cash that we actually received. In this case, $35,668. We debit cash short and over account by $22. The reason why we debit it is because we're under the cash by the difference. If we were over, it would be a credit instead of a debit. And then we credit our sales for the full amount of sales that we made, $35,690. Makes sense? You're all still with me? I know. It's boring.
One question, Professor.
No, can you hear me?
I can hear you now.
Okay, no, it's under. So why are we debiting cash? That's under assets. Debit means
We're not debiting cash, Lynette. The name of the account is the name of the Lynette. We're receiving cash in this transaction, right?
Yeah.
$35,668. The name of that second account is cash short and over. That's not cash.
Okay.
That's not a cash account. That's actually a liability account.
Okay.
It's just the name. I'm sorry. It's just the name of the account. That's probably why it's a little confusing.
Okay.
So the reason why we're debiting that account is, remember, your debits need to equal your credits. Your sales credit, the total sales was $35,690. The total cash you received was $35,668. That leaves a difference of $22. Well, I can't credit that because we were under, right? So that's why it's a debit. Does that help to clarify it a little bit?
Yeah, I thought you said we're going to debit cash. I thought $22. I thought that's what I heard you say.
I'm sorry.
It doesn't make sense. Okay.
All right, I'm sorry about that. I must have.
I'm just saying now.
Yeah, I must have rattled it off a little too quick. I appreciate your question. Thank you so much, Lynette.
I had a question also.
Go ahead, Pavle.
So, okay, we record and everything, but what we actually do with if we have a more, like for example, like let's say that we have a $22 more, what we actually do with that cash? Are we like, I mean, if we are like in restaurant business, or are we like is this like tip? Are we like, what we are doing with that money?
Yeah, so if you're over by $2, you just, I mean, the reality is you keep the $2. The difference is you credit cash short and over by the $2. But yeah, I mean, you keep the $2. It's almost impossible to go find the customer that overpaid you by $2. You know, so realistically, you keep it, and you make sure that it's included in your physical cash amount, and that it's also included in your over amount, your cash short and over amount by the $2.
What if we are like short for $2? Do we need to give from our pocket?
No, it just gets recorded as cash short by the $2. Yeah, nothing really happens from that. It's just a matter of how we record it.
Okay, thank you.
Yeah, good question. Some businesses might require you to do that, but most cases, no. Yeah, that's another story. If there's a cash shortage, the cash short and over account is debited. If it's an over, it's credited. So short or under, it's debit. If it's over, it's credit for that account. At the end of the accounting period, a debit balance of cash short and under is included in miscellaneous expense on the income statement. Because you know at the end of the accounting period, at the end of the year, end of the month, we can't have a cash short over under account. It's a temporary account. So as you know, with temporary accounts, we have to close them out. How do we do that? In this case, we expense it as miscellaneous expense on the income statement. Yeah. And if it's over, then we debit it as we credit it as other income. Other income. Cash received in the mail. Never put physical cash in the mail. Never do that. That is dangerous. Don't actually put physical cash in the mail. Never do that. It's very bad. It will go missing. Cash received in the mail from customers when they pay their bills, typically by checks and money orders. Sometimes I'm a little old-fashioned myself. There's certain bills that I'll pay with a physical check. It's rare, but sometimes it happens. These days, everything's done digitally, through the bank, through the website. But some of you are like me, and you like to pay with a check or a money order. So you fill out the money order, you put it in the mail with the receipt, and it goes to you, or we call it the remittance, and it goes to the company that you're paying it to. An example of that would be like a water bill. You get a water bill from WSSC, and you're like, oh, okay, I got to pay my water bill. So there's a little thing at the bottom. You tear it off, and you put it in the envelope with your check. That little thing you tear off at the bottom is called a remittance advice. Remittance advice. It's like a coupon, and it basically traces the payment. It helps when the company receives that, it helps them to track the control of that payment and make sure it goes to your account, not somebody else's. I've seen that happen too. You see a lot of crazy things in business. Okay. EFT, electronic funds transfer. I oftentimes will pay my bills over the phone or through the internet. We call these EFTs, electronic funds transfer. It basically authorizes your bank to pay for a service to a company through the internet. Yep. You do this when you purchase something from Amazon. You do this when you pay for gas at the gas pump, when you swipe your debit card. A debit card is also EFT, electronic funds transfer. It's the most common way that people pay now. In fact, our country is currently experiencing a shortage of physical cash. That's because not a lot of people are using paper money these days. A lot of it is debit cards, or they're buying it through the internet or over the phone. In these cases, a company sends a customer a bank signs authorizing the monthly electronic funds transfer. So sometimes, like, you have a recurring bill, like I pay my rent every month, first of the month, right? Like probably most of you. So when you pay your rent or your mortgage at the first of every month, it's some of you might have it automatically deducted from your bank account. That's the simplest way, right? That's it. That's also called an EFT, and you're basically authorizing the bank to do that monthly. And that's what this slide tells us. EFTs are easy, they're quick, they're faster than the mail, right? It's done instantaneously. Nobody has to handle physical cash, so it reduces the possibility of theft. And it reduces the possibility of late payments because of the speed of the transaction. It's a nice thing with EFTs. How do we control cash payments? Payments are made only for the authorized transactions. Cash is effective and efficient. and ensures that it's available for the purchase of a discount sort of take. Nice and easy. Voucher systems. Oh, this one's interesting. Voucher systems is a set of procedures authorizing and recording liabilities and cash payments. A voucher. A voucher is a document that serves as proof of authority to pay cash or issue electronic funds transfer. Well, the way I want you to think about a voucher is it's like a coupon, but it's as good as cash, right? And you might use a voucher. Let's say you were scheduled to take a flight somewhere, and you had to cancel that flight for whatever reason, and the airline said, hey, you know what? Instead of giving you a refund, we'll give you a travel voucher. That travel voucher is the same as cash. The business treats it the same way as cash. Yeah. Another example, let's say you prepaid for a meal at a restaurant, and your reservation was for Valentine's Day. And you're like, you know what, I unfortunately, I can't make that. What the restaurant might do is they'll say, okay, we'll give you a voucher so you come back for that meal at a later date. Yeah. Hotels do the same thing. Store credit? Yeah, Lynette. Yeah, exactly. That's another form of a voucher. Exactly right. So Lynette asked, is store credit another form of a voucher? The answer is yes. So for example, let's say Lynette went into Macy's and she found a really awesome outfit that she wanted to buy. And she bought it, and then she's like, oh, you know what? I really like that other outfit better. I'm going to go to the store and return it. So Lynette returns the outfit. And then the store goes, well, you know, instead of giving you cash refund, we'll give you a voucher, or store credit is what they call it. It's the same as a voucher. Yeah, absolutely. Very, very good. Gift cards. Pavle asks, is it similar to gift cards? Kind of, yeah. It can be. It depends. If it's a gift card that's designed for a specific place only, then the answer is yes. If it's like a Visa gift card or whatever, the answer is no. It has to be for a specific place. Yeah, good question. Yeah, vouchers are real interesting. So it's the idea is for the purchase of goods or services, and it goes to the vendor, right? That's the idea behind them. In a computer system, we document it through the purchase order and enter directly into the computer files. So vague, right? We do a journal entry. At the due date, the checks are automatically generated from the mail of vendors. At the time, the voucher is electronically transferred. Yeah, that's cute. Vouchers get pretty complex, so. Cash paid by EFT is electronic funds transfer. It's done automatically. Other example would be direct deposit. If you are an employee somewhere and you have direct deposit, that's also a form of EFT. David asked Section 8 voucher. Yeah, similar. Very similar. Yeah. No, you're right. You're right, David. That is a great example. Yeah, it's the same exact concept, no doubt. Yeah. If you have direct deposit with your employer, that is a form of an EFT that's deposited to you. Some companies have automatic payment set up with their vendors and suppliers. It's also a form of EFT that's paid out. Oh, withdrawal from an ATM. That's a form of cash paid by an EFT. Bookstore voucher. Regina. Oh my goodness, so funny. Yes. Bookstore voucher, same exact idea. You guys crack me up sometimes, let me tell you. Yes, bookstore voucher is also a voucher. Bank statements. We use bank statements to identify and control cash, the payment and receipt of cash. We look at our bank statements to identify our cash on hand how much cash left in the bank? Oh, look at our bank statement for that. How much cash we used that month? Look at the bank statement. How much cash we received that month? It's on the bank statement. Hopefully you've all seen a bank statement at some point in the past, but a bank statement has the cash you've received and the cash you paid out. It lists all your checks that you paid and all your EFT transactions. Yeah, that's a bank statement. Why are bank statements used in accounting, you might ask? We use bank statements to match up all of the transactions that we use cash for, to validate those transactions, right? The bank statement shows us our deposits, our deductions, and our ending balance, and our beginning balance. This is an example of a bank statement. It shows us our beginning balance, shows us our deposits, our withdrawals, other debits and credits, and our new balance, also known as our ending balance, or beginning balance for. Yeah, I'm sorry. New balance is the ending balance for that respective month, or the beginning balance for the next month, depending on the dates, right? So interesting. So you see here your deposits from your customers, from the checks. So when it says number and then the number, that's a check number, and it shows the amount for each one. It shows the deposits, when they were deposited, and then on the right side shows your balance increasing from those deposits, or the balance for that day. Yeah. And then we have our ACHs, our expenses, right? These are cash coming out of the company, for various expenses, and we see those, and then we get to the bottom. Yeah. So why is it important to look at these? We do this thing called bank reconciling. We reconcile our cash in our company, in our accounting system, at the end of each month. We do that using the bank statement. So, and I'll talk about that here in a little bit. But the bank statement includes deposits and electronic funds transfers into and out of the business. Also shows collections of note receivables from your customers, proceeds from a loan that the company made or was given to you by the bank, interest earned on the company's bank accounts or paid in some cases, and the correction of any bank errors. So all that stuff is on your bank statements. Bank statements also might include things like service charges by the bank. Oh, that's why, by the way, just a little word of advice, personal advice, okay? Personal finance stuff. I don't like national banks. In fact, I despise them. I don't like Wells Fargo. I don't like Bank of America. I don't like Chase. I don't like any of those big banks. What do you want to know why I don't like those big banks?
What?
Their interest rates are terrible. Their customer service not so great. They treat you like a number instead of a person. They often charge service charges for the accounts. Those are the reasons I don't like them. Oh, and their fees are really high. Those are the reasons I don't like them. I prefer credit unions. I think local credit unions are fantastic. They're a little bit more personable. They have higher interest rates. Their service charges are lower. That type of stuff. That's my personal perception. Some of you might like big banks and you've had good experiences with them, and that's fine. But personally, I just don't like the fees and the other stuff. I don't like paying big banks to have these big towers in these big cities, and that's where that banks make most of their monies, from fees, right?
Professor,
Yeah, go ahead.
I'm under the assumption that when it comes to credit unions, you either have to know somebody to get in there, or you either work for the government. But for like general public,
sometimes that's the case. But you can also join PenFed Credit Union. PenFed is open to everyone.
Okay.
You don't have to be a government employee or serve in the military or anything like that. They're a credit union and they're open to everyone. There's a few of them out there. And the other cool thing, Lynette, is you don't even have to be in the same state as that credit union, right? Sometimes you do, but most of the time you don't. So yeah, take a look around. They're out there. And also, like, even through your employer, like if you're a government employee for the district or for the state of Maryland or the state of Virginia or for another state or whatever, there's a credit union called the State Employees Credit Union. That one's good. Navy Federal, that's another great example. Yeah, that's a credit union for sure. There's a ton of them. Yeah, take a look around. The smaller banks are way better than the big ones. That's been my experience, at least from that perspective. Some of you might work for the big banks. No, I'm sorry. I'm sorry I wrote all over your employer. Okay. Making debit entries for the bank's payments made to electronic funds transfer, service charges, customer checks, refunds, correction any bank statements. You see all this stuff in the bank statement. What do we do? So we reconcile our bank statement. At the end of every month, the cash balance on your statement of cash flows, on your balance sheet, the cash balance should match the cash balance in the bank, right? We call that reconciling. The idea is your cash balance in your accounting system, your QuickBooks or your whatever, should always match the cash balance in your bank account. That shows you that it's accurate. Yeah, we'll talk about that when we get to reconciling. On the bank statement, there's a couple of codes. These codes help you to quickly identify what it was. EC, error correction. NSF, non-sufficient funds. I've seen that one a few times, right? Service charges. I don't like service charges. I really don't like it. I don't want to pay the bank just to hold my money. That's silly, right? This is why I promote the credit unions. ACH, automated clearing house. These are for electronic fund transfer. That's what it basically means. When you swipe the card, your debit card, it shows up as an ACH on your bank statement. Yeah? That's for the electronic funds transfer. And then MS, miscellaneous. The bank statement shows balance of cash. It should not be different from the company's cash balance. If it is different, you need to reconcile it. And it'll always be a little different throughout the month, but at the end of every month when you do your reconciling, the date of the end of your bank statement, the end of your bank statement date, and the cash balance in your accounting system should match for that same date through bank reconciling. It's important that it happens, right, in order to prevent errors. So if you look here, the bank statement is a little off. Well, why is it off? What you see here is I received a few more, my beginning balance was a little off because oftentimes what happens is we don't properly account for fees from the bank and for any checks that haven't cleared yet. When you hear the word clear, it means that the person you wrote the check to hasn't deposited it yet. And because of that, it hasn't cleared. So therefore, it may not show up on your bank statement yet, but it's already in your accounting records. So what do? We do this thing called bank reconciling. It's where we match the bank's statement to the cash balance on your balance sheet. And we do that through the adjusting entering process. And it's designed to make sure that we enter our bank fees, and we help us to identify which checks have cleared, which transactions have cleared the bank. So, and this is an example of how we do that. Yeah. Very good. How do we prepare a bank reconciler? A couple of steps. Step one, we enter the cash balance according to the bank statement at the ending cash balance. Step two, we add any deposits that we have not yet recorded. And an example of this is when there's a deposit and transaction. Step three, we deduct outstanding checks that have not yet been paid by the bank, meaning they haven't cleared the bank yet. And step four, we determine the adjusted balance by adding step two and subtracting step three. Step five, we enter the cash balance according to the company from the ending cash balance in the ledger. Step six, we add credit memos that have not yet been recorded. Step seven, we deduct credit memos that have not yet been recorded. Step eight, we determine the adjusted balance by adding step six and subtracting step seven. Step nine, we verify that the adjusted balance equals the bank. So fun stuff, right? It's a long process. Good news is I'm not going to force you to do it in this course. Because it's easy, but it gets long and boring, and it's just not as fun. Okay, here's an example. Bank statement shows a balance of $3,359.78 as of July 31. The cash balance on the balance sheet shows $2,549.99. Obviously, there's a difference of a couple $100 here. Let's figure out what happened. So step one, I've identified. Step two, there was a deposit that we have not yet recorded on the bank statement of $816.20. So we make sure that we identify that hasn't been recorded yet, hasn't cleared yet. Step three, we issued 3 checks that have not yet cleared the bank that total $1,544.99. Step 6, we have a note receivable plus interest collected by the bank but not yet recorded in our journals. Step 7, we have a check from a customer for $300 that was returned by the bank for non-sufficient funds. And there was a bank fee for that of $18. So what you do is it's a matter of adding, subtracting until you get to the point where your bank statement equals your cash balance. It's kind of a long and tedious process. Well, that's asking where are we adding to. So we add to the cash balance if the cash balance does not reflect the deposits that we made to the bank. So in other words, you go into your accounting system and you have your bank statement in front of you and you have your accounting system on the other side and you're looking at both of them together. And we realize, okay, my cash doesn't equal my cash in my accounting system. So that means that we have to make some adjustments. We're either going to add or subtract cash depending on what happened with the bank. And we're also going to make some other entries that we may not have made, like bank fees. And we do that at the end of each month, typically. So, good question. So how do we do that, you might be asking? So there's a couple of journal entries that we would need to make. We received a payment from a customer account for $408 on July 31. So when that happens, we debit cash and we credit the receivable. $408 received in cash. $400 of that was a receivable, and $8 of that was interest. Because remember, it says notes receivable. When you see notes receivable, that means it was a loan to our customer. It's kind of like a line of credit. Yeah. The second transaction is we debit the account receivable for that customer. We debit miscellaneous expense. The miscellaneous expense comes from the $18 bank fee for the non-sufficient fund transaction. We debit accounts payable for the company that we need to pay for $9, and we credit cash $327. Fun stuff, right? Yeah, I know. Sometimes it gets a little confusing, but it's just a matter of following the steps. The idea behind bank reconciling is to ensure that the company's records match the bank statements. And this also helps the company to make sure that we don't misappropriate any funds. Yeah, that's the idea behind it. For those of you in hospitality, this one's fun. Okay? And a lot of hotels have this. A lot of restaurants also have this. It's called the petty cash fund. The petty cash fund is a special cash fund that we use for miscellaneous things. Okay. So sometimes we have to do things on the fly, especially in the hotel business. Sometimes you got to do things on the fly. You don't have time to go up to the accounting office, ask them to write a check, because we know that's going to take a day or so. So what do? You go to the petty cash fund. It's a separate cash drawer of cash that we use for small things, for small purchases or small events. Example. I would use a petty cash fund if I had a guest at the hotel, and let's say I'm working the overnight shift. I'm working the night audit shift. I got a customer, a guest that comes into the hotel late. Like real late. They missed the hotel shuttle van from the airport. Okay? So what happens when that happens? They show up in a cab. The hotel, at least we did, we would go out to the cab and pay the guest cab fare using petty cash as a service, right? Or we ran out of postage stamps to mail out thank you cards to our guests. So you take a little cash out of the petty cash fund, you run over to the post office, you buy some stamps. Or another instance where we had a guest at the hotel that came in late and the restaurant closed. So, okay, the guest is hungry, and so we'll buy them dinner using petty cash, right? Those types of things. Minor repairs, office supplies. We use petty cash because we simply, the accounting office is open from 9 to 5, Monday through Friday, and in most businesses. And so because of that, things happen outside of 9 to 5, Monday through Friday, especially in a hotel or a restaurant. So because of that, we have petty cash. So what do? We take cash out of the petty cash fund and we put a receipt in the cash's place. The receipt is the way that we track the cash that's used from the petty cash fund. And those receipts are our way of tracking the cash. We call it custodial. It's a chain of custody, basically, is what that is. So the petty cash fund is replenished when it's depleted in intervals, or when it reaches some type of minimum amount. Petty cash fund is replenished by debiting the expenses that the cash was used for and crediting cash, right?
I have a question, Professor.
Yes, Pavle.
So can we use, like, instead of cash, can we use like company card for like that kind of purchase, small purchase, or no?
You can, but it's different. It gets recorded differently. So a company credit card is a liability account, not an asset. But yeah, you could use it for small transactions as long as the receipts are collected, and as long as you fill out the expense report to be reimbursed, or for that card to be reimbursed by the accounting department. So it works a little differently. A company credit card is a liability account, not an asset account, because it's a credit card. Yeah, good question. Absolutely. Okay, here's an example. We assume we have a petty cash fund of $500. To first fund that cash fund, what we do is we debit petty cash and credit cash. Remember, cash is an asset account. We debit petty cash, which is also an asset account, and we credit cash, which is also an asset account. It's still cash. It's just petty cash and cash. It's still cash, but it's two separate accounts. The only time petty cash is debited is when we're establishing that fund. And then we credit it to decrease it. To decrease the petty cash fund, it represents the purchase of things using that petty cash. In this example, we purchased $380 of office supplies, $22 in stamps, $35 in store supplies, miscellaneous $30, giving us a total of $467 of petty cash that we used for that month of August. And so the company will need to replenish that cash after a while. So what do? We debit the expenses for each of those expenses that we use the petty cash for, and then we credit cash because we used the petty cash, right? So that's petty cash. That's petty cash. Another account that's used once in a while is called a special purpose fund. Special purpose fund is a separate fund for payroll or travel expenses. It's kind of like a once in a while fund. So that's why I call it special purpose. It might be used for either payroll or travel. The only time it's used for payroll is when we're giving out bonuses, or there's some weird thing that happened with somebody's payroll check and we have to make a correction for it. Cash and cash equivalents. Cash equivalents. This is another interesting term. Cash is normally listed as the first asset under current assets, as you know. The company may temporarily have excess cash once in a while. Sometimes the company will invest into high liquid investments so it can earn interest. Sometimes a company might purchase what we call a CD. Not a music CD, a CD. A CD is called a certificate of deposit. It's a high yield investment for individuals and companies in order to gain interest. So if a company has extra cash just sitting around, I don't like cash sitting around. I want my cash to make some money while it's sitting there. So they'll invest in things like U.S. Treasury bills, notes issued to corporations, also known as bonds, and money market accounts. All of these will help the cash to earn interest. So you'll see a line item on some companies will say cash equivalents. Those are investments that the company used cash for and is gaining interest on them. Some banks require what we call a compensating balance. This is required for loans or lines of credit. It's basically like putting money into escrow. Escrow is like a guarantee that you will use those funds for that purpose. Some companies will use escrow or some type of line of credit for a guarantee of funds. So we use this thing called compensating balance. It's rare. It's very rare. I just want you to know about it. Days. Okay, a couple of ratios you need to know. Cash on hand. It's important to understand how much cash on hand you have and how many days the company can survive with that cash on hand. Okay. Cash is very important for business. Not just because we use cash to grow the business or to pay expenses, but we use cash as a barometer of its survival. And so to figure that out, we calculate this thing called days of cash on hand. Days of cash on hand we calculate by taking cash and short-term investments. Cash and short-term investments. That's not a subtraction sign. That's a, what do you call a hyphen, right? Cash and short-term investments divided by daily cash operating expenses. Daily cash operating expenses. Cash and short-term investments are taken from the year-end balance sheet and represent liquid assets. The daily cash operating expenses are computed from the income statement. How do we calculate daily cash operating expenses? We take our operating expenses minus depreciation expense divided by 365. So on this example, we take our we're trying to figure out cash on hand daily for days, right? Cash, short-term investment, operating expenses, depreciation expense. So what do? We take our cash plus our short-term investments divided by daily cash operating expenses equals days of cash on hand. Higher the better. The more days of cash on hand you have, the better off you are, typically. And that, my friends, is the end of Chapter 7. Are there any comments, questions, concerns for internal controls and cash? Anything that we haven't answered for that? Are we good? You're all still awake? I know it's lunchtime.
Yes, sir.
Wonderful.
I'm not okay. I don't know what in the world is going on right now when we say the cash on hand. I'm low.
Okay.
I don't know what I'm looking at. I don't know what I'm seeing. I'm seeing lines. What are we managing? And help me, please.
Sure. Okay, Lynette. So when we're looking at days cash on hand, what I'm looking at is how many days can the company survive with the amount of cash that it has? Okay, that's the whole idea behind days of cash on hand. Yeah. It's a calculation that management makes in order to understand how many days a company can survive with the amount of cash that it has on hand.
Okay.
And the formula is cash plus short-term investments divided by daily cash operating expenses. To find daily cash operating expenses, which is that bottom line, we take the operating expenses minus depreciation expense divided by 365. Operating expenses and depreciation expense are found on the income statement.
Yeah.
Divided by 365. So that would be the bottom part of that equation.
Oh, okay. Now, okay.
Does that make more sense?
Yes, it does.
Wonderful. Wonderful. And then those last 2 slides were just the example of that. Yep.
Okay.
Great.
Thank you.
My pleasure.
I have a question.
Pavle, go ahead.
So if I understand correctly, for this this will be everything on the midterm exam, am I right?
Mm-hmm. Yep.
So we can like start today and then record, and then if I want to go one more time through the PowerPoint and everything, and then I can like continue on my exam.
Absolutely. Yep. The midterm exam covers chapters 1 through 8. Yeah, you can. It's open book, open note. You can start the exam now. You can save. Don't submit. Don't click submit. If you click submit, it'll submit it. Okay. Click save and close, or save and then close it. So that way it saves your answers. So that way you can come back to it and keep working. Yes, of course you can.
Thank you.
Yeah, my pleasure. Okay. Any other questions for this chapter before we move on to chapter 8? Chapter 8's not as long, but it's definitely something we got to cover. Okay. I'm going to stop the recording for this session, and we'll start the next one here in a second. Bear with me.